A bear call spread is a type of vertical spread, meaning that two options within the same expiry month are being traded. One call option is being sold, which generates a credit for the trader. Another call option is bought to provide protection against an adverse move. The sold call is always closer to the stock price than the bought call. As the name suggests, this trade does best when the stock declines after the trade is open. However, there can be many cases where this trade can make a profit if the stock stays flat and even if it rises slightly. We'll look at lots of examples later in this post, including how to manage the trade when it goes against you. Bear call spreads are risk-defined trades. There are no naked options here, so they can be traded in retirement accounts such as an IRA. Traders should have a bearish outlook on the stock and ideally look to enter when the stock has a high implied volatility rank. As you can see, the scanner shows some interesting bear call spread trades on stocks such as MSFT, INTC, AAPL, TKO, and PYPL. Below are the full parameters for this scan. Days to expiration, 0 to 60 days. Security type, stock. Volume leg 1, 100. Open interest leg 1, 500. Moneyness leg 1, minus 5.00% OT 5%. Probability, above 25%. Volume leg 2, 100. Open interest leg 2, 500. Ask price leg 2, greater than 0.05. Let's take a look at the first line item, a MSFT bear call spread. Using the December 17th expiry, the trade would involve selling the 320 call and buying the 330 call. That spread could be sold for around $7.20, which means the trader would receive $720 into their account. The maximum risk is $280 for a total profit potential of 257.14% with a probability of 25.9%. The break-even price is 327.20. This can be calculated by taking the short call strikes and adding the premium received. As the spreads is $10 wide, the maximum risk in the trade is 10 to 7.20 x 100 equals $280. Therefore, if we take the premium, $720, divided by the maximum risk, $280, we see that this bear call spread trade has the potential to return 257.14%. MSFT has a strong day yesterday, closing 2.11% higher on the day. This bear call spread on INTC involves selling the 47.50 December put and buying the 49.50 put. That spread could be sold for around $1.39, which means the trader would receive $139 into their account. The maximum risk is $60 for a total profit potential of 227.87% with a probability of 37.7%. The break-even price is 48.89. INTC is rated a strong sell and the Barkhart technical opinion rating is a 100% sell with the average short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. INTC is showing an 4 percentile of 33% and an 4 rank of 20.94%. The current level of implied volatility is 25.62% compared to a 52-week high of 45% and a low of 20%. Mitigating risk. Thankfully, bear call spreads are risk-defined trades, so they have some built-in risk management. The most the INTC example can lose is $60. Position sizing is important so that a 100% loss does not cause more than a 1 to 2% loss in total portfolio value. Bear call spreads can also contain early assignment risk, so be mindful of that if the stock breaks through the short strike and it's getting close to expiry. Please remember that options are risky, and investors can lose 100% of their investment.